consider this a professional courtesy.
Hello, everyone, and welcome to another edition of Real Estate Realities with the Rebel Broker. My name is Robert Whitelaw, and I am the Rebel Broker. Licensed real estate broker in the state of California, member of the National Association of Realtors. But please, don't hold that against me. Welcome to the middle of the week, folks. I hope everything is going well for you. Another reminder, we're going to be doing the drawing for the $50 Amazon gift card this Friday at 5 p.m. Pacific time, so make sure to get your submission in before then. What is the best way to do that, you say? Well, let me tell you. The best way to do that is to head over to therebelbroker.com, click on the big red button at the top of the page titled Take the Survey to Support the Show. Use the same email address both times you're asked, answer a handful of demographic questions, and you are done. You've helped the show, thank you very much, and you've put yourself in that drawing for that $50 Amazon gift card. Why do you need to use the same email address both times? Well, because it's a verification process, and when you win, I will be reaching out to you using that email address. It's how I verify the winner, and it's also how I distribute the winnings. So please make sure that's an email address that you check on a regular basis. If I don't hear back from you within about 48 hours of letting you know you've won, I move on to another winner. Okay. Of course, there's other things you can achieve at the website if you'd like. You could join the Rebel Underground. You can join the Rebel Underground by clicking any one of the many links. The player that plays the show at the webpage has got an embedded link in there. Join the Rebel Underground right there. Or if you'd prefer, you don't happen to be in front of your computer, you're listening on your phone, you can simply text the word Rebel Broker, the number 44222. That's text the word Rebel Broker to the number 44222. All right. We have got a good one for you today. One of the things I love doing is sort of looking at the data, looking at what's being put out, relating to where are we hoping to get the greatest return on investment in the coming year. Lots of different folks put this one out, and the good folks over at biggerpockets.com have done so with their article, Real Estate Markets in 2018, the Biggest Losers and Winners. And it's, of course, this is going to be a great way for you as an investor or as a buyer, right? If you're somebody who wants to, let's say you have the flexibility. Now, I have plenty of my clients that I've been working with here in Silicon Valley have got the flexibility to really pick where they're going to live in a lot of ways because they're able to work remotely. I realize that's not true of everyone. Some folks have to absolutely show up for where they're going to work. I have an awful lot of clients who tend to be in the high-tech world, coders, programmers, those types of folks. And I know folks who work for local companies that live in Los Angeles and Portland and Seattle and Las Vegas and Boise, because they were able to get a better deal there. They're able to make the same amount of money they'd make if they were living here for the most part. I'm sure there's some sort of a gimme there that happens in terms of pay, but the amount they're saving far outweighs it. Now, of course, wouldn't it be smarter to weigh part of that decision on areas where you're most likely to see the greatest return on investment on your property? Now, and for those of us who are investment minded, who want to focus on these areas where we're going to make our money work for us the most, because we're not going to live in them, we're going to rent them or potentially flip them and maybe rent them for a little while, then sell them. This is great data to have. So I thought it would be a great one today to review this one, go over the top and the bottom of the list, and sort of see what we think about these areas. Do these make sense to us? Are these in areas that are good for you in terms of maybe steering you more towards considering these areas for your next investment? So let's go ahead and jump right in and take a look. They went and took a look at the factors most likely to impact home prices in 2018. And they've actually got a separate article on this relating to that. What are the things that they came down with? And in their analysis, they came down with a few items I figured it'd be good to share. Number one was affording the roof over your head. Number two was where will home sales and prices go? So in other words, anticipating the direction that prices are going for homes. Mortgage rates, The tax man, what are your tax expenses in these areas? When nobody knows, the housing market is just one part, albeit a large part, of vast economy in the United States. So it's going to experience ripple effects from changes in other parts of the economy and social structure, such as employment, education, transportation, and infrastructure, credit, politics, consumer sentiment, and many other components. Next on there, and that was it. That was the last on their list. When it's difficult to predict what to expect tomorrow or next year, consumers have trepidation to take on major financial commitments. Loaning money becomes riskier for the lender, and generally there's an overall wait-and-see strategy for signals on future movement, all of which result in challenges for the housing industry. Although the overall economy in the U.S. is robust, uncertainty is rampant. There's quite a bit of unpredictability surrounding inflation, et cetera. All right, so those are sort of the big rundowns on the 5 housing trends that they are focusing on. In terms of looking ahead, they focused on 382 metropolitan statistical areas in the country. They looked at affordability, home sales, home price growth, mortgage rates, taxes, and less predictable geopolitical events, which we kind of just ran down here. What they found is that many of the historically hot parts of the country are softening significantly, and the less exciting low-growth markets are seeing acceleration. So this is stuff to know. Remember, we've talked about this a lot. So many investors are drawn into the sexy headlines. And over the past 2 years, what we've seen is the sexiest headlines point you into marketplaces that give you the lowest return on investment. Now, my area, Silicon Valley, San Francisco, has been on many of those lists. And granted, if you bought something a year ago, 2 years ago, 3 years ago, you're absolutely seeing great appreciation on the property, or you have seen great appreciation on the property. But in terms of what you can charge in rent, you've got an awful lot of money invested into this marketplace. And if unless you're buying with a lot more down than you'd normally want for an investment, you are not positive cash flow. And then when you do the math and figure out how much that investment is paying off for the rent you're making, it's not a great piece of math. It does not give you a great capitalization rate for that return. Other areas are seeing much better returns with minimal investments compared to what you'd have to make in the Silicon Valley area, for instance. Okay. Now they're using House Canary for a lot of this data, which is kind of cool. For those of you who haven't tried House Canary, let me suggest you give them a look. They are pretty cool. I'm still in the evaluation phase. Now, they have not paid me a dime. House Canary has not paid me. There's been no advertising. I have not talked to them at all. All I've done is consume data from their website and read articles where the folks who are writing the articles are using data from House Canary. Let's say one platform, Infinite Insights, is their lead in here. Earn more in U.S. residential real estate with data science, predictive analytics, and advanced software. So you guys know I am a data geek, so I am all about trying to get as much data as I possibly can. And they've got some great data here. I'm trying to learn more about it, so maybe I'll give you a more in-depth look at this at some point in the future. But very cool stuff, and I like their data. It seems relatively reliable, not biased in any way, not weird in terms of trying to sell you on a certain point of view. So maybe take a look if it's something that you're interested in checking out. All right, so what we're focusing on here are different areas that are likely to give us a better return on investment. And something that's interesting to note right off the bat, one of the conclusions that the folks over at Bigger Pockets came to, which I thought was super interesting, definitely fits in with what we've been talking about in terms of this feeling of a slowing. They say, quote, across the board, the gains markets make in 2018 will be less dramatic than in 2017. Investors will want to pay close attention to the MSAs that are part of the biggest gainers group and MSAs in the biggest losers group in order to be aware of tailwinds and headwinds, respectively. So I think that's exceptionally valuable data or advice. I strongly support that. And we've talked about it here. And one of the goals on the show has always been to point you more towards markets that have somewhere to go, that aren't sort of hitting their apex, like Silicon Valley. Now, let's go ahead and start with the expected change in growth rate. And really, that's how this is sort of organized. We can talk about a lot of different markets here, but it's really organized by how much growth can we expect to see? And it's really amazing how so many markets are expected to see a decline in growth rather than an increase in growth. Now, we're going to talk about some that are still going to have positive, right? Because remember, so much of what we're going to see this year is not likely to be declines in values, but a reduction in the rate of increase, a more flattening of the marketplace. So that's something to keep in mind as well. All right, so let's get into the list here because it's kind of interesting. We don't have a complete list. Now, as I mentioned, House Canary is a great resource, but it is also a expensive one. So it's best to leverage off of what they share in their blog, which is something I check out on a regular basis. But then also take advantage of the different outlets that create news items like this one based on their data. I mean, the last time I looked, I believe it was $1,000 a month to be a subscriber to their data stuff. I believe if you just wanted to do house valuations and things like that, it's substantially less expensive. But if you want to really be a data geek and get access to everything, it's a far more expensive proposition. So probably not for your average consumer, but their blog is super interesting. So that's something you're going to want to add to your list of things to check. All right, so let's go ahead and review their list. It's interesting. I would love to get my hands on the entire list, but sadly, I don't have access to that. Number one on their list, and some of these ones surprise me just because of other things that we've talked about on the show. But let's talk about the change in growth rate. They've only got 3 on here that are in the green. In other words, that are seeing 0% change in their growth rate or a positive change in their growth rate. But what's more interesting about this list is also some of these communities that are going to see huge declines in the growth rate. And let's keep in mind, these are projections, right? These are 2018 projections. So number one on the list is Scranton, Wilkes, Barre, Hazleton, Pennsylvania. I know nothing about this area, but the 2018 growth rate is projected to be 3.4%, which is a 27% increase over 2017. Next on the list, another one that surprises me based on other things we've talked about, although we've tended to talk about things relating to downtown New York, Manhattan, is number 8 on their list is the New York, Newark, Jersey City, New York, New Jersey, Pennsylvania metro, with expected growth rate in 2018 of 5.3%, with a 19% increase. Now, what's interesting is some of the things we've covered is how hard hit New York City has been relating to actually seeing declines in costs of apartments. So I'm not sure how that figures in. It's a little bit contradictory in terms of other data we've looked at, but it's interesting. Definitely something to consider. And one of only 3 places on this list that are showing up as positive. I'm sure there's tons more. Again, we just don't have access to the entire list because we're not subscribing to the raw House Canary data. Number 32 on the list, still in the green with 0% change. They're expecting a 5.1% rate of growth in 2018, which obviously is the same rate of growth they had in 2017, is Toledo, Ohio. I believe Toledo's come up on a couple of lists for us before. As a place for opportunity. There's a second article that they're actually that they have over on House Canary that I think is interesting. It's a heat map showing returns on rental on average for these various states. Let me also suggest you take a look at that because I think it also gives you some interesting information on where to shift your gaze if you're interested in having investments that you hold on for as rentals. Ranking number 50 on their list is the Chicago, Naperville, Elgin, Illinois, Indiana, Wisconsin area with a 4.3% expected rate of growth in 2018, which is a decline of 11%. I'm not going to hit all of these. Now, some of these, I'm going to hit some of the big areas because they so frequently affect us in terms of what we hear. Number 67 on the list is Seattle, Tacoma, Bellevue, Washington, with a still staggering 12.1% growth rate expected in 2018. But that's an 11% decline from the previous year. So the expected 2018 growth is less growth than what they saw in 2017. Denver, Aurora, Lakewood, Colorado ranks at number 73 on their list with a 9.3% growth rate in 2018 to be expected, which is a 15% decline from the previous year. Dallas, Fort Worth, Arlington, Texas, which is coming on their list at number 80, is expected to have an 8.1% rate of growth in 2018, which is a 22% decline from last year. That is a huge decline and kind of surprises me, to be honest. simply because I continue to hear that as a destination for folks who are moving out of here. Now, granted, the rest of the country can be feeding or not feeding that beast, but I know from my personal on the ground experience, Dallas remains one of the main places folks are going to. This next one is a huge slowdown. Number 81 on the list is the Los Angeles, Long Beach, Anaheim, California area, which is expected to have a 4.9% growth rate in 2018, which is a 32% decline from the previous year. The Atlanta, Sandy Springs, Roswell, Georgia area coming in at number 84, 5.5% growth rate expected in 2018, which is a 36% decline in growth rate. The Las Vegas, Henderson, Paradise, Nevada area is number 86 on the list, expected to have a 6.9% growth rate in 2018. Now remember, these are all respectable growth rates. What we're focusing on here is the slowdown, and they're expected to see a 32% slowdown in growth rate. Number 88 on the list, San Jose, Sunnyvale, Santa Clara, California, right in my own backyard, expected to have a 5.4% growth rate, but that is a 39% drop from the previous year. San Francisco, Oakland, Hayward is number 89, following close on its heels with a 5.8% growth rate, also experiencing a 39% drop. Portland, Vancouver, Hillsborough, Oregon, Washington, number 90 on the list, with a 6.7% growth rate in 2018 projected, and that's a 35% drop. Now we get into some really interesting ones in terms of breaking that 40% barrier. Now, up until now, we haven't had anything over 40% in terms of their expected level of decline from the previous year. At number 93, we've got Miami, Fort Lauderdale, West Palm Beach, Florida, 4.4% expected growth rate in 2018, which is a 49% drop from the previous year. So a 50% slowdown in the rate of growth for that area. Number 96, Deltona, Daytona Beach, Ormond Beach, Florida, with 7.6% growth rate expected in 2018, which is a 40% decline from the previous year. Now, here's a whopper. We've talked about these areas before. These have been popular areas for quite some time. Number 97, Cape Coral, Florida, and Fort Myers, Florida, are expected to have a 3.4% growth rate in 2018, but that is a 60% decline from the previous year. So a huge slowdown in that marketplace. Number 8, a lot of Florida properties are getting hit hard, or a lot of Florida regions are hit hard here. Lakeland, Winter Haven, Florida, 5.4% expected in 2018, which is a 51% drop from the previous year. Northport, Sarasota, Bradenton, Florida, 3.8% expected in 2018. That's a 66% drop from the previous year. And Palm Bay, Melbourne, Titusville, Florida, 5.8% growth rate expected in 2018, which is a 57% drop. Now remember, none of these are in the negatives. None of these are actually seeing negative growth. They are all positive growth. What we're trying to understand in this particular equation is what areas are showing a level of slowing in their growth that indicates we might be having a position where we're peaking. Now, why would we care about that? Well, as a buyer, you may want to know that, because if we're hitting a peak, usually a peak means that after the peak is over, we start to see some level of decline, or at least a very long period of stagnation at the very least. If you're an investor, if you're someone who owns property in these areas and you see numbers like this, where you see a slowdown in appreciation, and you're someone who's exercising a buy, hold, then sell strategy where you're renting it, particularly if you're in a place like Northport, Sarasota, Bradenton, or Cape Coral, Fort Myers, where you've got a 60%, 66% cut in the amount of growth expected for 2018, you may be experiencing a period where the smart move would be to liquidate that and move over to some of these other marketplaces that represent a better investment. Now, in that line, I want to share with you a little bit about the regions of the country that are experiencing the best rental rates. But before we do, we're going to take a quick break. But when we get back, we'll cover that. So don't go away.
Are you ready to jump in and start your search for your first investment property? Maybe you've decided that it's time to own your own home, or maybe you're ready to sell your home and move on to something new. No matter what your goal is, the Rebel Broker can help. That's right. Aside from hosting this show, I am also the owner broker of Whitelaw & Sons Real Estate Services, right here in Silicon Valley. With over 25 years experience serving Silicon Valley, Morgan Hill, San Martin, and Gilroy, I or one of my great agents can help you achieve your goals in real estate. So if you're ready to look into taking that next step towards achieving your real estate goals, point your browser at www.soldbyrobert.com. That's www.soldbyrobert.com and get in touch. Let me show you how I will earn your business and your respect. Again, that's www.soldbyrobert.com, or you can call me at 408-852-0525. California Bureau of Real Estate ID 00984-909.
Welcome back, everyone. We're taking the data we just talked about, which is giving us an idea of how much certain marketplaces are slowing down in 2018. And now we're going to blend it with some more data from House Canary that's talking a little bit more about the greatest areas in terms of rental yield. And we're going to do that by state because it also gives us a regional insight into the areas that are performing the best. Now, before I get into this, I want to make one thing clear. We're talking about state level stats here. So that doesn't mean if I tell you that one of the worst states in terms of performance on rental yields is California or Nevada, that doesn't necessarily mean that you should walk away from those areas. It means that deals are where you're going to find them. And California particularly is all about submarkets. There are places in California where you could do exceptionally well. Same goes for Nevada. But in general, it's a tougher market. So by looking at these statewide numbers, you're kind of just getting more of an insight into areas that might have fewer barriers or that might take less time to find some of these great returns on investment or yields. So take this as sort of a guide. In fact, if you're a brand new investor, some of these states that are showing really great yields might just be a great place for you to start, cut your teeth, get something going. If they're areas you already happen to live or travel to frequently, great. If not, and you're more comfortable with something near you, don't let data like this stop you from at least starting the looking process. It costs you nothing to get a search going to find properties that might fit your needs locally. Now, before we jump into these numbers, I wanted to read off what their methodology was. I think it's always important to understand how these guys put these numbers together. And according to the article, and there will be a link to this in today's show notes. So if you're interested in getting more data, please feel free to head on over to therebelbroker.com for those show notes. Quote, House Canary's data analytics group has indexed, normalized, and analyzed 40 years of U.S. residential property data spanning over 1 billion transactions and hundreds of macroeconomic and local data points to derive an accurate view of current home values and rental values nationally. The single-family, non-owner-occupied portion of these homes and rental values is used to derive the effective gross yield discussed in this document. Effective gross yield is defined as the current fair market annualized rent minus estimated property tax divided by the current fair market home value. Effective gross yield can be computed for individual homes, U.S. census blocks, zip codes, states, and the national level. Homeowner association fees and insurance costs are not included, as investors are able to add those costs at an individual portfolio level. All right, so this is a good one in terms of just really getting a broad feel for it. The West is the lowest in terms of rental yield, and some of the most exciting locations are ones that we've talked about before. It really tends to be the Southeast. Ones I'm looking at here are Louisiana with 10.5%. Let's see. Mississippi's looking really good with 11.2%. Alabama, 11.2%. Now, remember, we've actually had guests on the show who really had great things to say about Alabama. And we've had a couple of interesting stories come up about how great Alabama is. Another one, Kansas City, 11.4% rental yield by state. What state is that? That's Indiana, 11.5%. Ohio, 11.4%. West Virginia, 10.1%. So you can, and this is a heat map. So let me strongly suggest again, you head on over to the website, therebelbroker.com, click on the link for the House Canary article on fourth quarter rental investment index to get an idea of this, to sort of help guide you. This is great data. It doesn't mean you drop everything and head over to these particular areas. It just means that if this is data that sounds compelling to you, start a search. We live in an age where you can go onto the internet, go to Realtor.com, Redfin, Zillow, Trulia, any site you like. Start doing searches on the areas in these states and just see if the math works. It really is, and that's what's great about investing. It's all about the math. If the math doesn't work, you don't do it. It doesn't matter if you like what color it is or if you think you want to live in that neighborhood. You're not the person who's going to live there. So you can make it all about the math, and being comfortable with that is the first step towards really starting to move towards your goals in real estate if becoming an investor is something you really want to do. All right, folks. As always, the goal is to leave you with more good information on the table than the time you invested. I hope we've achieved that today. I hope we've at least left you with some great things to think about and potentially even help you move in a more productive direction as it relates to your investment decisions. Thanks again for listening, everybody. I'll talk to y'all next time.